Welcome back to the Principles of Managerial Finance. This is Chapter 2, Part 2. So we're going to continue where we left off in Part 1. And we're going to talk about issuing common stock. So we're going to start out with private equity. So not all companies have to go to the public markets. They can issue private internal equity by selling to private placements. So this would be an earlier stage of a company who's looking to grow the company and starting out with private investment placement, selling parts of the ownership of the company to some very wealthy private investors early on. Now this, an extension of this is what we call angel investors. So these are very wealthy individuals who are going to decide that this company is promising and it's a startup and they want to be involved in the company at a very early portion of the company. At a point in time where the company may be years away from making a profit. So by getting in early, though, they typically get a higher amount of equity for less money than at the IPO stage. So since they're taking a greater risk, it's because it's generally a smaller company, they get a greater return. Now, moving into venture capitalists. So a venture capitalist is a little bit more formalized business entity that their main focus is in private equity capital. So what they want to do is take in private equity capital from individual investors. Often these institutional investors, are going to work with larger pension funds or bigger individuals in net worth to make this private equity investment decision on their behalf. So venture capitalists is sort of can mean a few different things depending on the point of view, but they're basically are going to have the technical ability to maintain a good amount of oversight and investigation into the companies that they're going to take a stake in. So these venture capitalists, a large investor can invest in the venture capitalist, and then the venture capitalist can take that money and look to invest in other companies or acquisitions. So think of these venture capitals as a way of organizing money by professional money managers, to help set up larger pools of funds to buy bigger stakes in private equity of businesses. In some cases, buying the entire business. So it's not uncommon for a venture capitalist group to buy an entire company and later resell the company or bring the company public. Such as what happened to, say, companies like Dunkin' Donuts, which were bought by venture capitalists, repackaged, cleaned up, enhanced, and then sold into the IPO market. So when we're talking about some things that venture capitalists do is they look to get involved with companies and buy a significant portion of the company's equity or the entire company. So each deal is different. So they're going to structure a deal to figure out what would be the best investment for them. In some cases, it would be buying the whole company. In some cases, buying a portion of the equity of the company. So they have to everything is a deal. There's no really boilerplate template of what a venture capitalist would do. So there's a lot of factors involved in looking at the businesses and how the venture capitalists can be involved with the business to help the business, take a stake in the business to help develop and grow the business over time. And because the venture capitalists are getting in at an early risky stage, they're paying a smaller amount for the equity the ownership they're getting in the business than, say, a typical stock purchase individual would pay for stock that's on the stock exchange. Now, there's, different venture capital funds. You could have, I think the two most known are the financial venture capital fund, where they're going to be a subsidiary of a financial institution, mostly banks and say investment banks, to help set up and grow younger companies. And specifically that they take these partnerships hoping that they'll work with the bank in the future, become a bigger customer of the bank as well. So they're sort of growing their future potential customers. Now the corporate venture capital funds, these are funds of non-financial companies, and they're looking to perhaps gain access to new technologies or corporations that it could further their own growth. So these corporate venture capital funds, it might be a company that has a lot of extra cash laying around, so they'll have a fund of money that they look to invest in smaller businesses that may one day provide better technology for them and the partnership, or just be a customer down the line. There's the venture capital limited partnerships. These would be partnerships organized by venture capital firms, which are going to serve to help organize and invest the money of partners within the limited partner funds. And eventually, at some point, the fund will be liquidized and the capital returned to partners. So think of it as maybe 20 wealthy people come together, pool their money together, so they can make bigger purchases of other companies with the hopes of growing them to a point where they're going to have substantial returns. But the whole point of this is that the venture capital, whether it's coming from a fund or a partnership, is looking to get in early on very specific businesses that have the potential to become much more profitable and much more bigger businesses, but yet are at a stage where they're so small that they can't access the capital markets to issue stock yet or issue bonds. They're sort of a bridge to get these smaller companies to the point where they're ready to become an IPO. So the goal of these venture capitalists is to seek out and do the research to find the best of these companies that have the best chances of becoming bigger companies and becoming public companies. Or in some cases, they may not look for them to become a public IPO company, but just fix the company up, grow the company to the point where they can resell it to an even bigger entity later on and double or triple their initial investment. Now, once a company is big enough, then it's going to go in, the company is growing and there's still potential opportunity for it to grow even more and there's need of extreme capital, companies are going to look to go public. So if you have a company like, say, Tesla, that Tesla started out as a very small company, it gathered private investments, venture capital investments, until it got to a point where it was big enough to issue its own stock. And it needed that capital to build factories and grow its business. So going public, is a way of generating a huge amount of capital for a company to reinvest in the company. Now, when a company does want to issue its stock to the public, they can still do private placement of securities directly to an investor or groups of investors, such as pension funds or mutual funds. They can sell shares to the general public and even do a rights offering, which is selling new shares to existing shareholders to maintain their percentage of ownership. So these are just three avenues in which going public that the funds can flow through. Now, the initial public offering is the first time the company is bringing their stock to the capital markets. And for rapidly growing companies, growing their sales, growing their businesses, their profits, and there's huge market for them still to continue to tap into, such as a growing restaurant that wants to open 1,000 new locations, or a growing financial institution or bank that wants to open up new locations or expand its presence online. These initial public offerings can bring in a great deal of capital and also help to reward the early investors in the company, such as the early private investors or early venture capital investors who all have a percentage of ownership in the company. So that percentage ownership is going to get only enhanced when the company becomes an IPO. So before you become an IPO, though, the company has to issue a prospectus, which is a document that's going to describe the company, its key aspects, its key position in the market, future risks, and just outlay the financials as they currently are as a company, so investors have a good idea of what they're getting involved with. The preliminary perspective, which is available to investors during the waiting period between the registration of the filing and the approval of the SEC, is called a red herring. And then we have this quiet period that takes place where the company officials can't say anything new about the company during this quiet period, which is the gap between issuing the perspective and actually going public. And this is a way of preventing inside information from taking place or unfair dissemination of information that the perspective is supposed to fill in. And before a company goes public, they want to get as many people interested in buying the company as possible. The heavier the demand for the company, the higher the IPO price can be. So the higher the IPO price, the more money the company is going to receive when they go public. So they have to do what they call a roadshow, which is promote the stock to as many investors as possible and gather as much support and demand to help set the preliminary offering price of the stock. It's similar to how, say, a new movie was going to come out and then the stars of the movie go on a publicity tour of talk shows, media, radio, newspapers to help promote the movie to get more people to see it. Now, issuing the common stock is going to be the role of the investment banks. The investment bank is going to help the company meet its financial and regulation requirements to sell the new stock in a major financial institution. Now, and use the financial intermediaries to access the financial markets. So the investment bank is going to take a role of the underwriter to basically guarantee the selling of the security. So the underwriter is going to bear the risk of this IPO. So the investment bank isn't going to work with a company that they don't feel is going to work. So they only work with companies where they feel that they're going to be able to easily sell all the shares available with an agreed upon price. So the IPO offering price is the price at which the stock is going to sell in the primary market. So there's a battle between the price that the company ultimately wants the highest price possible, but the financial bank, the investment bank, wants to have a price that's going to guarantee a successful offering, which means that they're going to offer it at a price which will jump up 10 to 100% the first day and really enrich all of their partners that invested in the IPO that the investment bank put together. So it's really a negotiation or a struggle to make sure that the company gets a fair price for their stock and that investors get a stock that has the potential to go up a great deal in the first few weeks. Now, the role of the investment bank is to originate the IPO and help the company to solidify all its accounting and legal needs to make the IPO legally viable and acceptable by the SEC. Then the investment bank is going to put together a network of underwriting partners, or what we call underwriting syndicate, which is usually a group of banks which are going to help share the financial risk of this new IPO and get it sold into investor hands. Now, a tombstone is a list of the underwriting syndicate banks that are going to be involved as in selling the stock. So the selling group is going to be what the underwriting syndicate puts together, which is going to be a group of brokerage firms that are going to that you generally originate at the investment bank. They're going to accept the responsibility for selling a certain portion of the new shares of the security, if not all of the shares of security. And that sort of looks like this graphic here. So we have the company issuing the stock, and they're going to go to an investment bank who's going to work with this underwriting syndicate, which is going to be groups of other investment banks that are going to move it into the selling group, which is going to help push it into the primary market. So this selling group is going to try to push the IPO to pension funds, mutual funds, large investors. Unfortunately, with the IPOs, a small investor is not going to have access to buy the IPO in its initial public offering form, which is its initial price. They'll have to wait to it's traded the first day in the secondary market, which often trades at a 10 to 100% premium over the initial price. So it makes it a little bit unfair. If you're just a regular small-term investor, you're never going to be able to have access to these big IPO markets or these stocks, these very high potential stocks traded in this IPO market, because they're really just going to be for the primary investor groups, which are the wealthiest and largest companies. A very unfair process. Now, so the total proceeds, what does the company get? They're going to get the IPO offering price times the number of shares issued. So that's the amount of proceeds for the total IPO. Now, some of these proceeds do go to the investment bank. But the total proceeds, majority of them will go to the company issuing the IPO. But the investment banks can negotiate a portion of the IPO price or a portion of the shares that they're going to get as compensation for bringing the company public. Now, the stock price, which we call the market price, is going to be determined by the interaction of buyers and sellers in the secondary market. But before it reaches the secondary market, the IPO price is going to be a negotiation between the company issuing the stock and the investment bank. And then once it's traded in the secondary market, the supply and demand in the secondary market will make up the current market price. So the market capitalization of the stock, at any point in time, we look at the current stock price times the outstanding shares, and we call that the market capitalization, or what the current value of the company is. So the IPO price isn't really known until the final hours before trading. So the final trading price is going to occur on the first day of the market. It's going to appear, the first day it appears in the secondary market, it's going to appear at the final trading price and then trade from there. Now, what the investment bank wants to do is, ideally, they want to have the IPO underpriced. So they want to have the IPO a little bit underpriced to what it's actually worth in the market. So that way, the first day, the stock price will move up, and that is seen as a successful IPO. If the IPO is launched and the stock price goes down in the secondary market on the first day, that's a very bad sign for the stock. It means investors are not interested in it. So typically, most IPOs are underpriced when they're first issued. And then we can determine the amount of underpricing by taking the market price minus the offering price divided by the offering price. Now give us the IPO underpricing percentage. Okay. Now, moving into financial markets, we can also do something called moving away from stocks and bonds. Some other powers or interesting areas of financial institutions are securitization. So this securitization is just the process of making large pools of money out of small instruments. So pulling together car loans, credit card debt, mortgages, student loans, and selling them as a much bigger pool in the secondary market. So, for example, a big area that made the headlines during the Great Recession was mortgage-backed securities. So the idea here is if you're a bank and you only own one mortgage, that's very risky. So if you're a bank and you own 10 mortgages, all your profits can be wiped out by one mortgage not being paid back. So a lot of banks want to sell the mortgages to a security broker or an investment bank who's going to repackage them and resell them, or some other financial institution. So that way, the financial institution will give, or the financial intermediary will give the banks their money back for the mortgages, plus some additional compensation, and then they'll repackage these mortgages into one giant fund that could represent 10,000 mortgages, thereby greatly reducing the individual risk of an individual mortgage not being paid back. So the security is going to represent claims in the cash flow of this pool of mortgages, and the homeowner, the risk of the homeowner not paying their mortgage is going to be much smaller because of the large pool of mortgages that are put together. So this is what's considered to be a very safe investment, but due to the housing crisis in 2008, these mortgage-backed securities became the poster child for why the Great Recession occurred. But in general, they do help these securitizations and these mortgage-backed securities do help move the money around. So if banks get recapitalized by another institution buying their mortgages, they can go now and initiate more mortgages. So a lot of these banks at the commercial level, they make money initializing the mortgage, fees and commissions that they get paid for initially creating the mortgage, and then they sell off the risk to another entity, get recapitalized, and have more money to issue more loans and more mortgages and more car loans. So it keeps the money flowing from people who want to invest in safe investments or have a higher return to keeping the banks fully funded so they can make even more loans. So it really does help to move the financial money around the markets to provide the liquidity for people who want to borrow money and provide investment opportunities, safer investment opportunities for people who want to save money. And 99% of the time, that's what the securitization does. But that 1% of the time where it fails, we could see that quite clearly in the financial crisis of 2008, where home prices went up dramatically and fueled this home buying frenzy that came crashing down. So we do have periods where home prices can rise pretty steadily. So we had a pretty steady real estate market between 1987 and 2006, where mortgage default rates were low. And why these mortgage default rates were low was because if the housing values go up and you can't pay your mortgage, you can always sell your house, retain the capital of the growth in the value of the house, pay off your mortgage, and walk away with a small profit. So everyone wins. But as people got so comfortable with how safe these mortgages were and these mortgage securitization was, the lenders started relaxing standards for borrowers and creating these subprime mortgages. And they become, since people initiating the mortgages were divorced from the risk of the mortgage failing, they became a lot more greedy and were basically accepting anybody who wanted a mortgage. They were very encouraged or motivated to put them in a mortgage so they can originate their finding fees and then later sell the mortgage to a securitization and divorce themselves of the risk. As the housing prices fell from 2006 to 2009, many of these borrowers, when they got in trouble during the recession, were unable to refinance or resell their house to secure the mortgage. So as a result, the sharp increase in the number of delinquencies imploded the mortgage securitization market. And these subprime mortgages were proliferated in these mortgage pools, and they wound up, just creating these really risky pools of mortgages. And when that became discovered, people obviously were moving their money out of them, and that sort of imploded the financial market at that time. So here we could see that the housing market moved up very nicely to a peak around 2005, 2006, then falling again during this mortgage crisis as more and more houses became foreclosed. The prices started to drop as people started to lower their prices in an effort to sell their house to be able to pay off their mortgages when they became in trouble financially. So this created this crisis of confidence with banks, and these delinquency rates on these mortgages helped to, scare people out of the financial markets and pull their money out of stocks and bonds. And a lot of banks began failing because their mortgage businesses dried up. And we had, 3 banks fail in 2007, but 25 banks fail in 2008. 140 banks fail in 2009, and then 157 banks fail in 2010 because the value of this whole mortgage business sort of imploded. So it wasn't until 2015 where these bank failures fell back into single digits that banks started recuperating from these losses. And this is just a look of the index, the Standard & Poor's Banking Index. You can kind of see that greatly drop 2009 and slowly make a comeback. Now, as an effect of this, Great Recession that we had in 2008, banks became under more of a microscope. So the intense financial pressure, they tightened their lending standards. They dramatically reduced the quantity of their loans, and increased the quality of their loans. They kind of woke up and said, we got to, only lend to quality people and, focus on reducing risks. So as corporations found that they could no longer raise money in the money market, but only could do so at much higher rates, this was sort of a reflection of what happened in that Great Recession. So as a consequence, because businesses started hoarding cash because they were afraid of not being able to borrow money as the economic activity was contracting. So it was sort of a credit crisis that occurred simultaneously in the Great Recession, where, the lending had dried up quickly, so companies became worried. They started hoarding cash, and they stopped buying capital goods and investing their money. So that sort of brought the economy to a halt. It was only by the Federal Reserve encouraging, being a lender of last resort and refunding the system, and funding some of these activities directly, that they were able to unfreeze the credit markets and get everything moving back together by having sort of like a huge amount of money pumped back into the financial system, even to the point where giving money to banks and telling them to lend to help revive the economy. So once that Great Recession was resolved in 2009 and the regulations went through, the economy started to come back to life and came roaring back to life over the next 10 years until the financial crash in 2020, where between March 2009 to January 2020, the market, to the S&P, rose almost 300%. Then we had a world health crisis in the spring of 2020, where financial markets quickly dropped 30% in 23 trading days, and one of the most rapid declines in history. But 12 months later, the market doubled. So why did the market double even when the economic consequences of this medical crisis crippled or reduced a huge amount of demand in the world economies? Well, it's because the Federal Reserve and many of the Federal Reserves around the world pumped trillions of dollars of stimulus, and there's no place greater than the United States as far as pumping stimulus into the economy, directly cutting stimulus checks directly to its citizens, and extending and enhancing unemployment benefits, which helped stabilize the economy. And as stock investors saw that the Federal Reserve was not going to let the economy fail, they quickly moved back into stocks. And when the economy started to, certain sectors of the economy naturally benefited from this crisis, such as pharmaceutical and biotech, computer industries, chip semiconductors, video games, certain things that you didn't have to go to a store to buy and that you didn't have to go to a public market. Their stocks greatly expanded. And there were a few stocks where, if you owned a mall or a movie theater, these types of companies naturally declined during this period. But overall, stocks leaped forward above the pre-crisis levels, as the Federal Reserves were very generous in supporting and supplying funds to the capital markets. And at the end of this, as inflation starts to develop, you'll see the Fed moving the other way, where they're going to tighten. That now that the financial markets in the world economies are on a steady footing again and growing, they'll look to pull back their financial stimulus and tighten to help prevent runaway inflation. Okay, that's the end of part 2 of chapter 2. I look forward to talking to you in chapter 3. Take care.